Hello and welcome to your weekly market update from Nutmeg. This will be a regular series of webcasts designed to keep you updated on what's been going on in the financial markets and to share some insights from the Nutmeg investment team. My name is George Mitten, investment writer here at Nutmeg. In a minute, I'll introduce our Chief Investment Officer, James McManus, whose image we can now see on our screens, who will give us a short presentation, about 10 or 15 minutes, giving us some context to the recent market environment. He's got some really eye-catching slides that do a great job of explaining the scale of what's happened lately. After the presentation, we'll have a Q&A session. We understand that in this difficult market environment, many of you have questions, and this is your chance to have them answered. We've had a great response in advance of this webcast, about 40 questions so far. You can also ask questions while James is speaking using the Q&A feature on Zoom. I'll do my best to curate these questions and ask James those at the end if we think the topic hasn't already been covered. To let you know, this webcast is being recorded and will be available to watch again if you like. You'll also be able to share the link with friends or contacts who might be interested but who aren't able to join the webcast today. Many of our viewers today are Nutmeg customers, but we understand that some of the people tuning in aren't and are currently seeking information about us and our investment strategy. If you're in that group, welcome. If you've indicated that you'd like to know more about us, my colleague Cully Samra will be happy to chat to you more directly in the next few days. That's enough from me. I'll now introduce James. In case you hadn't guessed, like many businesses in the UK, Nutmeg is currently working entirely remotely, so James and I are not in the same room, but thanks to the technology, that won't be a problem. Over to you, James.
Thanks, George. Thanks for the introduction and good afternoon, everybody. I'd like to extend that welcome and thank you all for being customers of Nutmeg. I'm sure many of you are dialing in from home, given the current circumstances, and in that regard, I'm no different. So I join you today from my kitchen table, where my office desk has been transplanted for the time being. So on that note, I guess I'd first like to reassure you all that Nutmeg is fully operational remotely. We have for some time been testing our business continuity plans, and we actually had some critical teams rotating between the office and working from home for a number of weeks. This, combined with our policies around flexible working that we've long had in place at Nutmeg, means that we're well placed to operate under the most unusual of circumstances. That said, you will appreciate that we're experiencing a significant increase in the number of customer support contacts that we receive. It is our busiest time of the year, with tax year end just 2 weeks away. So rest assured, we recognise this is a stressful time for many people. We're working hard to make sure that we get to every query as quickly as possible. So Nutmeg continues to operate as normal. Our team are working hard to manage your investments in what is an exceptionally challenging environment. And we appreciate the trust that you put in us to do this on your behalf. So today we wanted to cover a number of topics and provide a short 10 to 15 minute presentation covering what we've seen going on in financial markets over the last couple of weeks. What are the policy responses been and where do we expect to go from now, and how are Nutmeg portfolios positioned? And then, as always, we'll move on to answer some direct customer questions, and we'll do our best to answer as many of those as is possible in the time that we have. So let's start with financial market performance in March. And here we can see how a range of major financial assets have performed so far in the month of March relative to their long-term volatility. So the further right on the x-axis, that's the horizontal axis, the higher the long-term volatility, and the further towards the top of the y-axis, the vertical axis, the greater the performance. So the first thing that we observe here is that most assets actually have performed in line with their long-term risk-reward profile, and that is that we see riskier assets such as emerging market equities and small-cap equities witnessing the steepest falls, and there is quite a linear relationship between government bond performance, corporate bond performance, and equity performance in terms of the risk and reward of these asset classes. The second thing to notice here is that there really haven't been too many places to hide from market volatility during March. The US dollar is the best performing asset in this chart, but even traditional safe havens such as UK gilts, US treasuries, US government bonds have produced only small positive returns, and many safe havens have delivered losses, such as gold. Though clearly, the losses have been significantly better than the losses we've seen in corporate bond or equity markets. And the third thing that really stands out to me on this chart is really the value of diversification. So we've plotted here in green a number of Nutmeg fully managed portfolios and their performance over this period. And what we can see is that portfolios, even with significant equity exposure, between 80 to 100% equity exposure over the long term, have performed much better than many individual equity markets. And remember, diversification is the principle of not putting all of your eggs in one basket. So spreading your risk across a broad range of asset classes, country and sector exposures. And albeit over a short period, this chart really demonstrates the value of diversification in investment portfolios. So I wanted to pick out a number of interesting charts to discuss and that I hope will help frame what has happened in markets over the last couple of weeks. And the first chart here is market volatility. And this is a chart of an index called the VIX index. It is in essence a reflection of expected volatility in the US stock market. And as you can see, volatility by this measure has increased substantially in recent weeks to a level significantly above its long-term average. And actually at points it's exceeded the levels that we saw during the global financial crisis. So although that's now begun to fall somewhat from that highly elevated level. So this is a sign of market stress, but it's also a sign of investor uncertainty and to some extent fear. But the important thing to note on this chart really is that volatility rarely remains elevated for long periods of time. Volatility tends to spike as investors face uncertainty, and then it tends to fall as investors become more confident about what the operating environment is, and they have time to digest events and what they mean for various different investment classes, asset classes. So we've seen a sharp rise in volatility, and that's really been a major theme of recent weeks. But also the velocity of the sell-off has been a theme, and the velocity has really been unlike anything we've seen in recent memory. So investors use the term bear market to describe a loss from the peak of a market of 20% or more. And what we've just witnessed was the fastest bear market in history in the S&P 500, taking just 16 days to reach a minus 20 performance. And that compares with the average of around 270 days that it's taken historically to reach the same point. So the speed of the move has really been historical, and you can see this reflected in the first chart when we compare both the period of 2008, 2009 to the most recent period. So you can see the steepness of the fall in the past month versus a much slower, steadier decline during the financial crisis. It's worth remembering the financial crisis. The S&P, the US stock market, started to decline in October 2007, but it didn't reach that negative 20% until May the following year. So it gives you an indication of how sharp the recent sell-off has been. And that's really a reflection of the speed of how the coronavirus issue has evolved. 3 weeks ago, there were no lockdowns. Italy's issues were only emerging. The speed at which this story has evolved has really caught markets off guard. But when we talk about volatility, we also reference the day-to-day moves and the extent to which these are larger than we typically experience. And that can be both good and bad. In the past month, we've seen the biggest one-day drop in the S&P 500 since Black Monday in 1987. We've seen the third biggest decline in history, and we've seen 2 of the top 10 biggest daily declines since 1927. But we've also seen the 10th and the 11th biggest daily gains in history. And the chart in the bottom left-hand side helps demonstrate how the magnitude of daily moves, both up and down, has grown recently relative to its recent history for the S&P 500. So you can see the magnitude of daily moves is significantly above what we've typically experienced in the past 5 years. Away from stock markets, we've seen the economic risks begin to be priced into corporate bond markets too. This chart shows you the cost of insuring against default for $10,000 worth of US high-yield bonds. These are bonds issued by companies with lower credit ratings, meaning they're higher risk, they're less worthy borrowers over the long term, but then of course they should offer higher rewards. And what we can see is that the cost of insuring against their default, against them not paying back that debt, has increased materially in the past month, from around $300 to over $800, and that's nearly a threefold increase. So that reflects investor concern that an increasing number of these companies are going to have cash flow and affordability issues with their debts in the months to come. And some of this is related to exposure to the consumer sector, travel sector, the leisure sector, the hospitality sector, which has been particularly hard hit by the abrupt stop to activity in some regions. But there's also a connection here with the oil price. And as we covered in our last webcast, global oil prices have fallen significantly since the OPEC plus nations failed to reach an agreement on supply cuts. Saudi Arabia's subsequent action to materially increase the supply in oil markets has then resulted in lower and lower oil prices, which, as we've previously discussed, are troublesome for companies and businesses and countries that rely on oil revenues, but actually quite beneficial to those countries or companies that are large consumers of oil. And a cut to the price of oil also acts as almost a tax cut to consumers, given the lower input costs of a key resource. But the important point here really is that oil prices are now back down to levels that were last seen in 2003. And that's phenomenal if you think about it. You can see how the oil price rose through the early 2000s as we saw globalization advance, and emerging market economies in particular saw huge growth in their oil consumption. And that really brings us back to high yield bonds, particularly in the US market, and why a low oil price is problematic. So around 13% of the high yield bond index consists of energy companies. Many of those energy companies will be connected to the shale oil industry in the United States. At the current oil price, many are going to fail to break even. The break-even point for shale oil is estimated to be somewhere between $48 to $54 a barrel on average, way below the current $23 a barrel. This raises the prospect that many of those companies are now going to find their debts unaffordable in the short term. And that's why we're seeing investors price much more risk into the asset class following the shock hit to oil prices and to oil demand. So we talked about what hasn't performed well, but what about the safe havens? The assets that investors flock to when there's market volatility, and the assets that have historically helped investors really diversify their portfolios. Well, here again, in the short term, we see some quite interesting trends. It's worth bearing in mind we are talking about the short-term period here. So when we look at the performance of these safe havens, we're looking at the performance of only a couple of weeks, but we do see quite a mixed picture. Firstly, gold. This is the chart in the top left-hand side of this slide. The market sell-off really began, the equity market sell-off really began on the 19th of February, which is highlighted here in red. What you can see is that whilst gold performed well in the run-up to the start of the market volatility, investors have actually seen losses since, down around 7% to the close on Friday. And this really reflects a number of things, including investors' use of gold as an inflation hedge. Inflation expectations have fallen sharply and are partly driven by a strong depreciation in the oil price. And then also the increasing cost of gold, particularly in high demand emerging markets due to the strength of the US dollar. So as the dollar strengthens, gold becomes more expensive to many consumers in emerging markets. The performance of another so-called safe haven is shown on the right-hand chart. So this is the Japanese yen. The yen is often viewed as a traditional safe haven asset by investors. But again, here we see that the result has been a bit of a mixed picture since the sell-off began. The yen rallied initially in the first 2 weeks or so of the market sell-off, but it's since given up most of its gains. Again, the US dollar really strong, rallying against the yen in the middle of the month as investors focused on the most liquid assets that are available. And that includes assets such as US Treasuries and the US dollar. When we talk about liquidity, and we talk about what do investors flock to when they're in need of liquidity and in need of safe havens, we've always believed at Nutmeg that there is no substitute for US Treasuries and the US dollar. And this chart shows you that US Treasuries have performed particularly well since the start of this market crisis or market sell-off in February, but have actually been performing for some time through 2019 as well. And this is a chart of relative performance of Treasuries versus UK government bonds. And this has been a core position in Nutmeg portfolios. US Treasuries have been our preferred safe haven for some time, and the performance of US Treasuries has really been turbocharged, if you like, by the monetary policy that we've seen in the US. The US had more room to maneuver on interest rates, more room to cut interest rates, and the significant monetary policy we've seen from the Federal Reserve has really helped Treasuries outperform gilts in this period. So away from markets, what has been happening in terms of policy to help economies cope with the unprecedented disruption that they face? Well, we noted in our previous webcast that there were three types of responses that we thought were needed: the medical response, the monetary policy response, and a fiscal policy response. And so far, we've seen a significant and far-reaching monetary policy response. This is the response from central banks to lower interest rates, to free up liquidity in the system, and to promote orderly financial markets. The Federal Reserve in the US most recently this week announced its commitment to unlimited quantitative easing. That's the purchasing of securities in order to seek to support financial markets. But we knew going into this market crisis that the central banks had a lot less room to cut interest rates than they have had in previous economic cycles. Given their relatively low starting point for interest rates, their ability to cut interest rates is limited versus what they've had, versus the room that they've had in the past. And so we've needed governments to take up more of the burden of stimulus. And we're now starting to see really meaningful progress on fiscal policy. These are the policies of fiscal policies, the taxes and the government spending. These are the policies from governments that will really support businesses and workers in the economy. They're the policies that can have a quicker economic impact, that can help secure jobs, support businesses, open up funding to businesses, and stop this temporary shock to activity becoming a much deeper and more prolonged recession. So in the US today, we're expecting the approval of a $2 trillion package. That amounts to about 10% of US GDP, and that really is quite a significant package. It's going to provide support to employers' payrolls, backing of loans to businesses, and checks of around $1,200 to many Americans. And it's a significant stimulus given that its relative size to US GDP. In the UK, we've seen significant and quite quickly enacted fiscal policy moves, allowing companies certainty over their payrolls again, allowing emergency financing to companies. The fiscal package delivered in the UK so far is around 2.5% of GDP. Which sounds small in the context of the US package, but actually it's bigger than the fiscal package the UK delivered during the financial crisis in 2008. And bear in mind, that's been delivered much quicker in a much shorter period. So the policymakers have really been quite active and proactive here. And then even in Germany, a country with a long-held tradition of balancing its budget, Germany's launched a whole new era of fiscal policy in the past week, recognizing the extent of the threat to its economy. Again, around the 10% of GDP mark in terms of the stimulus that they're proposing. Remember, though, that many European economies went into this crisis with quite lackluster economic growth at the end of 2019, and that really makes recession quite inevitable now for a number of major European economies, despite the stimulus that's been put in. Where does that leave us on the outlook? Well, first and foremost, we also need to see a continued medical response, and that is likely to mean further shutdowns in activity, further restrictions in movement based on what we've seen being so successful so far in terms of containment. There still is the expectation that this will be a temporary shock, albeit a very painful one. Some investment banks have now forecast GDP growth in the US to slow between 25 and 30% in the second quarter. So very meaningful slowdown in the US economy. So there is going to be a meaningful downgrade to growth expectations for the full year. And in fact, we're already seeing that in many of the forecasts. And the reality is that, we face a quite unprecedented situation, a shutdown in activity across economic sectors across the globe. And the evolving nature of this virus makes forecasting resolutions to it difficult. However, we do hold the view that this is likely to result in a global recession by at least one of its typically agreed criteria. But it's worth remembering that not all recessions are as long as 2008, 2009. This isn't about the buildup of excesses in a system. This is about a supply and a demand shock. So if the virus can be contained effectively and quickly, then a recovery can begin in earnest. So with that in mind, how a Nutmeg portfolio is positioned. So this is for our fully managed and socially responsible portfolios. Just a reminder, we're underweight equity exposure in our portfolios. We hold less equities, less risky assets than we typically expect to do over the long term. We also hold a lower exposure to smaller US companies and also in Europe, and that we've reduced those in favor of adding to our technology exposure, given that those companies are very well capitalized. We maintain a neutral exposure to government bonds. We favor US Treasuries over UK gilts, and we hold much less high-risky corporate bonds than we would expect to do over the long term. And then, we hold more cash than we would expect to do over the long term. Bonds have become somewhat expensive. Government bonds have become somewhat expensive. But as uncertainty remains on the near-term outlook for equities, we are holding bigger cash positions in order to manage the risk in our portfolios. So one final chart before we move on and open this up to questions. So I think it's easy when markets are volatile to focus only on the negative performance days and on the endless stream of negative headlines. But this is really an important reminder about why it's so critical to be disciplined and to remain focused on time in the market rather than trying to time the market during periods of volatility. This chart shows you the occurrence of the top 50 worst days and the top 50 best days of performance in the S&P 500 over the previous 25 years. And what you'll notice is that when markets are volatile, they tend to move positively as well as negatively. In fact, the best and worst days tend to have some level of coincidence, that they tend to occur over similar periods. And so it's really important to recognize that volatility means greater moves in both directions rather than just losses. So trying to time the day-to-day moves in this type of environment is futile. It's very, very difficult. But focusing on the long term, allowing history to inform our behavior is clearly the best course of action. So I'll stop there. I hope that was useful. And we can now move on to answering some of your questions.
Thank you, James. And yes, some really fascinating slides there showing the extent of what has happened lately and quite how exceptional the last few weeks have been. I mentioned earlier that we'd had lots of really good questions in advance. We had roughly 40, and we've had lots of good questions coming in on the Q&A feature as James has been talking. We'll do our best to cover everything. As you can imagine, many people have posed questions on similar topics, so I've tried to group the questions by theme. Right, so we had a number of questions about the market outlook. Thanks to Johnny, James, and others. I'll read out one question on this from Juho, who asks, what type of coronavirus economic outcome is now priced in by the markets, James?
So, good question. I think, unfortunately, the outcome that's expected at the moment is a significant reduction in GDP, particularly in the US, but globally for the second quarter. Possibly the third quarter as well. It's really tough to forecast because the story has evolved so much in a month, and thus forecasters themselves are actually being forced to reforecast on a almost weekly basis. But there is a consensus now that this means a recession for many European countries that entered the year on a really weak footing from a GDP growth perspective. We talked before about the lackluster growth in some of the major European economies, and that was one of the reasons why we've not held as much European equities as we typically expect to do in the past 6 to 12 months. It's possible that the US may avoid recession, but I think it's likely to be one of the weakest years for some time in terms of global growth regardless. However, though, as mentioned in the presentation, recessions aren't always prolonged, and when we look at the two worst recessions on record, 1929, 2008, they were related to economic excesses and issues in the financial system rather than systemic shocks. So assuming that containment is successful in the short term, the medium-term outlook for the recovery towards, the medium-term outlook is for a recovery towards the fourth quarter. And bear in mind the size of the stimulus that's being pumped into economies from governments and central banks at the moment. It's almost like a turbocharge under normal circumstances. So if the virus is contained effectively, then the global economy is going to be really significantly boosted by the stimulus that's been injected so far.
Thank you, James. Yes, it'll be fascinating to see what happens once coronavirus is under control, as you say. Now, naturally, many investors have seen their portfolios fall in value in the past month due to these exceptional circumstances. I think I certainly have. I imagine, with your own investments, you've seen the same thing, James. So I think many of us can relate to one of our customers, Junaid, who says, I understand that this is a tough time. I have lost a quarter of the small amounts of savings that I have put aside over the past year or so. My questions are, should I still continue to make monthly payments? And when the markets go back up, would I make back the lost money?
So another good question, and yeah, you're right, George. Everybody at Nutmeg is invested with Nutmeg as well. So we're well aware of sharing the pain in terms of losses. I think if you're in the habit of making regular payments to your investment, and you don't need the money in the immediate term, then you should focus on keeping up your regular investments, because that's good investment discipline. Regular contributions can benefit from pound cost averaging. This is when you're entering the market over time and not cushioning your investment if markets fall, but also benefiting from an uptick when markets recover. And I think one of the best ways to meet your long-term goals really is to remain disciplined, and that means not making changes to your investments if your goals and your time frame haven't changed, and continuing to contribute to your portfolio as markets ebb and flow. And I think people often think about discontinuing regular investments when markets fall, but really this is quite counterintuitive, because if you were contributing regularly when markets were higher, your money now goes further because markets have fallen, your buying power has increased. So in order to maximize the benefit of any rebound, you should be continuing to contribute and retaining that discipline. And this is, I think, a good example of where emotions can influence our investment behavior in a negative way. The best investment decisions are always unemotional. And that's why we encourage customers to focus on the long term and not on the short term.
Thank you, James. Yeah, very interesting to hear your views there. So a lot of this kind of depends on the idea of a market recovery. Are we about to see one? How long is it going to take? We've had a lot of questions on the live Q&A on this topic. Do you have any views on the recovery?
Yeah, so we shared a number of data points on this. I think calling the bottom in markets is just as hard as calling the top. Market recoveries are incredibly hard to predict, as are market crashes. I think what we can do is look at history for some indication. History tells us a medium risk portfolio similar to a Nutmeg medium risk portfolio will have delivered losses of around negative 15% about 3 times since the mid 1990s. But importantly, after each of those falls, the average return over the next 24 month period over the next 2 years was 24%. So history tells us markets do recover. Patience is required. The investment team at Nutmeg are doing everything that they can to position portfolios appropriately for the balance of risk and reward in the medium term, and we are confident that markets will recover, and that we are, as I said before, in suffering from a temporary supply and demand shock in the global economy, that assuming containment measures can be effective, that the global economy will come out the other side of this in much better shape.
Thanks very much, James. You've partly anticipated my next question, which is something that a lot of people have asked about, thanks to David, Patrick, Niranjan, William, and others. I'll just read out one question on this topic from Sandy. The markets will hopefully bounce back when the pandemic is brought under control. What will Nutmeg be doing to maximize returns when this happens? So what can you tell us about your strategy, James?
Yeah, so we will be positioning our portfolios appropriately at all times for the balance of risk and return that we perceive from the prevailing outlook. So, containment is something that we're looking at very closely on coronavirus. We expect markets to begin to react to the huge amount of stimulus that's been pumped into the system. But we're also at a really critical stage. Markets want to see that containment measures work. They want to see patterns in containment that are successful. They want to see a path out of the crisis, if you like. And there are still risks to the downside at the moment. You know, most notably that the US is still to face the same degree of shutdowns as some European countries. In fact, the US appears to be taking a slightly different route to controlling the spread of the virus than many European countries. How successful that will be, we're yet to see the evidence of that. And the US also is behind the curve in terms of infection rate. So we're only beginning to see the US reach a point that Italy was at 2 or 3 weeks ago. So if we begin to see successful containments in some regions, and we are beginning to see the green shoots of those in areas like China and South Korea, then that's really going to build confidence that there is a solution to the problem, and that this is just a temporary shock. And I think that will help stabilize markets and start charting a path forward.
Thank you, James. Let's talk about risk levels for a minute here, because this is something that we've had a lot of customer questions about. Certainly our customer services, customer support team have. A lot of investors, in response to the current environment, they're thinking, should they do something? Should they change their risk level? Mostly they mean, should they lower their risk level? Although we are aware of a number of more adventurous investors who've taken this opportunity actually to raise their risk level. Thomas is in the former camp and asks, I'm currently on a higher risk strategy and have seen a large portion of my investment go. Should I stick with the high risk, or should I lower my risk for a period of time until the markets return to stability?
So I think the answer here is that you should stick with the risk level you're in, so long as that is suitable for your investment time frame and your risk appetite. So if your time frame has changed, if your goal has changed, then there may be a reason to change that risk level. Unless that isn't the case, then you really shouldn't be altering the risk level. You shouldn't be trying to time the market. You know, the evidence shows us that timing the market is incredibly difficult. And I think here it's really useful to ask yourself a key question. You know, when you decide to, if you intent on trying to time the market, the question to ask yourself is when will you decide to get back in the market? What is that once the market starts to deliver good returns? Because if so, then it's likely going to be too late. And the key here, again, is really just to be disciplined, to focus on your long-term investment goals and to ride out the volatility. So our long-term return expectations for portfolios don't change because of the short-term market volatility. So you can explore these return expectations using the projection engines in the edit part or the setup part function. But that will allow you to gain an understanding of the sort of return expectation we expect from different risk levels over time. But there shouldn't be a need to change those risk levels.
Thank you, James. Okay, we've got a slightly more Jeremy Paxman-esque question for you. So JB wants to know, knowing that the markets would typically take a hit, why didn't you sell out some holdings and then buy them again, i.e. in a typical bear market strategy as described there? JB gives the example of a well-known hedge fund which has shorted the market recently and asks, is Nutmeg's performance in comparison to that, does that demonstrate some kind of failing of automated robot systems, robo-advisors, and Nutmeg is sometimes described as a robo-advisor. What's your view on that, James?
Sure. So I guess firstly, we don't take short positions in the market. That isn't something we do. That level of sophisticated investing isn't suitable for the vast majority of investors, and actually is a particularly risky strategy. Which is why it's undertaken by high risk investments or high risk investment strategies that are run by hedge funds. I guess secondly, we aren't robots. We are a team of humans. We utilize human expertise at Nutmeg alongside technology to make processes more efficient, to lower the cost to customers, and to make our investment proposition much more accessible. So we don't really seek to trade portfolios. Rather we're seeking to manage the investment strategy with a medium-term view that reflects the balance of risk and reward given the current prevailing market and economic outlook. So portfolios have to be positioned for the balance of risks. And that is something we've done by reducing equity exposure in portfolios, and then also holding higher cash positions than we expect to do over the long term. And we went into this environment with quite a cautious stance in our portfolios. But it's worth remembering that our investment portfolios aren't total return portfolios. They aren't a hedge fund. Our highest risk portfolios will always have some level of equity exposure. They don't seek to profit in absolutely every single environment, and they're not immune to significant periods of market volatility, but rather they're built to perform over the medium to long term, to deliver investment returns through the economic cycle, and to be aligned with the timeframes that we offer our investment portfolios for.
Thank you, James. The questions are coming in thick and fast, and I fear we won't be able to answer all of them. So I'm going to pick some of what I think are the best, and I'm not going to spare you at all, James. I'm going to give you some of the really tough questions. The next one is quite a probing one, as it concerns us at Nutmeg. Chris would like to know, has Nutmeg experienced higher than average withdrawal of funds in recent weeks, and are there any concerns about Nutmeg's liquidity or cash flow position?
Okay, thanks for the question. Clearly it probably won't surprise you, Chris, if you're listening, that that is a key metric that we track as a business. Our data allows us to track client behavior. So we're really interested in ensuring that people meet their investment goals and have a good investment journey with us. So we do monitor the frequency of app logins, changes to risk levels, withdrawals. What I can say on that is, we over the past, so since Nutmeg has been managing money, we've had around 7 significant market downturns. And when we look at the behavior of our customer base over those periods, what we see is the vast majority of customers don't take any action at all. Around 97% of customers don't make any changes to their risk level and don't stop contributions or start withdrawals. So actually, the vast majority of investors are focusing on the long term. In terms of the liquidity and cash flow position, I guess there's 2 ways you can interpret that question. From the perspective of the Nutmeg business, at the beginning of the year, or the beginning of last year, sorry, we secured a Series E funding round. That was £45 million, and we welcomed Goldman Sachs on board as a cornerstone investor. So the business is really well capitalized. We continue to operate as normal. You should hopefully have recently received an update from our CEO, Neil Alexander, reassuring you that we're well positioned to operate in this environment. And you might expect that from a business that focuses on technology. I guess another way to think about your liquidity question is around the liquidity of the investments that we hold. That's something we monitor on a daily basis. We have an expert trading team at Nutmeg in-house, alongside a number of individuals who specialize in exchange traded funds. ETFs have really been acting as a liquidity sleeve for the global financial markets. We've seen a significant uptick in ETF trading volumes. On Monday alone in the US stock market, ETFs were 39% of all trading volume. Typically, they're around 20% of volume, and they're a much smaller portion of that in terms of assets invested. So we have seen the cost of trading increase, so the bid-ask spreads on the ETFs widen somewhat, and that's related really to widening of the bid-ask spreads, the cost of trading on all assets. So ETFs are a reflection of the underlying asset markets, and therefore when spreads widen on asset classes such as corporate bonds, then also the spreads will widen on ETFs as well. But that's something we monitor very closely, and actually we can maybe take that away and focus some of next week's webcast on that topic.
Thanks, James. Yes, I think ETFs absolutely is a topic that we're going to be returning to. How about this question that comes from Ian, which I think is related to the topic of ETFs, because it concerns diversification, which is something ETFs allow us to do at Nutmeg quite efficiently, as James will explain. Ian asks, how will we know if a company within our portfolio, within our Nutmeg portfolio, goes out of business? and will that affect the recovery? So I imagine, Ian, like many people, are looking at the economic environment at the moment, perhaps looking at the travel sector or the energy sector, and worrying that there might be some corporate events, maybe some bankruptcies. How would that affect Nutmeg portfolios, James, if any individual companies in the FTSE or the S&P 500 went out of business?
Yeah, so the average Nutmeg portfolio has around 8,000 underlying securities, within the ETFs that it owns, and so no one single company makes up any significant portion of any one of our portfolios. In fact, if you've been investing with us for some time, it's highly likely that there will have been companies within the portfolio that have gone out of business during that time. Our portfolios contain exposure to a broad range of developed market and emerging market stock and bond indices. So it's hard not to imagine that at some point in the past couple of years, one or two businesses there would have gone out of business. But you really are unlikely to have noticed, because they would have been such a small portion of the portfolio that the performance impact would be incredibly small. And that's really why we focus on diversification at Nutmeg. So the spreading of risk across a broad range of investment assets really helps mitigate the risk that any one country, one sector, one company can have on portfolio performance.
Thank you very much, James. I'm afraid, everybody, I'm going to have to call an end to this session now, because James has work to do. This has been a really stimulating session, certainly for me, just as an observer and as a co-host. We've got lots of questions that we haven't been able to come onto, I'm afraid. If you were one of the many people who submitted a Q&A question that we haven't answered today, I'm sorry we didn't get to you. We are going to take a note of all of these questions. We will be doing these sessions every week, so if your question wasn't answered today, we may well be able to answer it next week or the week after. So please do tune in again if you have time. If you don't have time at 11 AM next Wednesday, you'll be able to watch the recording after it's done at a convenient time for you. Once again, thank you everybody for joining. Thanks for your stimulating questions, and hope to see many of you at the same time next week. Thank you.